right, and we are here, real amigos. We have a special treat for you today. Not only do we have Sarah joining us, we also have coming back again from Mulletville, Kevin, the Mullet Knight.
What's up?
What's up, man? Good to have you back. Like I said, what we're going to try to do is when the market information comes out, we're going to try to have Kevin back so we can talk about the market stuff, and then at the same time, we have Fed announced, dun, 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 dun. The Fed does what the Fed does, and they announced that, guess what? We're going to go ahead and raise another 0.75. Sarah's going to talk to us about this, what this means for the housing market as far as with loans and fun stuff. But yep, today, Fed hikes interest rates 0.75%. Percentage points for a second conservative. Man, I literally just got done speaking in front of a group of agents, and so my brain is a little rattled. But yeah, welcome, Sarah. How's it going?
Yeah, it's going good. You know, we actually, I've been kind of limping around a little bit this last week. But besides that, I mean, we actually had good news today. So I'm happy to kind of talk about and explain that to folks, because I know there's a big misconception when they see Fed rate hike and mortgage rates, and it's not always, and they're not, one doesn't determine the other.
Right. And I think that's one thing that everybody hears, these Fed rates. And so they think that the interest rates for mortgages is going to go up. And so we'll talk about that in a second, how that doesn't actually mean that. So, Ian, we just got done. How was lunch, man? I missed lunch. Oh, you're muted, You're muted.
What?
There you go.
It was great. We went to the Domain and had a poke bowl at a True Food Kitchen, that sort of thing. It was good. Good to spend time with agents in person.
Nice. And
missed
so,
you, though.
Yeah, I missed. Yeah, I had to rush all the way home. I live further than you from the Domain. So a couple things to announce, though, that we did see that the prices for Austin dropped from 667 down to 615. I wanted to get both of your thoughts on that as far as prices dropping that far. Go ahead, Kev.
Yeah, I mean, obviously, I think you guys have probably felt that as much as I have, and it's weird because that's the obvious next step from 1,700 listed homes to 8,000 or 9,000 or whatever in such a short period of time. Obviously, those folks are going to have a bit of a price reduction. So, the first thoughts I think most people think is this is a negative. The prices are dropping significantly. It's just, the momentum going on the prices before carried it pretty higher than I think it probably should have been based on the number of homes listed. And this is, I think we said this last month as well. We thought it would get to around 600 or below and kind of stabilize. That's my thought. It still is. It gets running around high fives and 600 and stabilizes there for a while and then slowly climbs after that.
Yeah, I think we've all said that about the high fives, mid to high fives, low 600s, just because, and you brought it up a bunch of times on this channel, Jeremy and Kevin, and even you, Sarah, I think the bullwhip effect. The fact that people were panic buying because they had to move. They wanted to jump in on the opportunity. They saw it rising. They're like, we're not going to miss it this time. They think it's crypto. And next thing you know, reality is starting to hit and set in. So we've seen builders drop. It's still, let's see, you said 1,700, about 1,700 price decreases with less than 1,000 new listings in the last week. So that's also, I mean, it's indicative of a need to drop some prices for people.
Mm-hmm.
Yeah, I mean, I feel it's interesting about this, though, is I feel like a lot of those people that have been saying the word crash and saying the market's going to crash, they're going to use this as justification that the market's crashing. I've been, just to prove the point on my Tuesday video, my yesterday video, I literally wrote crash as big as I could, just to show people that you drive people to your channel just by saying the word crash. Yeah, but it's interesting. I mean, your points are pretty valid about, for the longest time, we've been saying that once we get more inventory, that things are going to change. And sure enough, we got a lot of inventory really quick. What do you think is some of the reasons for all the inventory that's hit the market in this quick in this short amount of time, Kevin?
Well, I think that people don't want to miss out. Like maybe 3 months ago, I'd say 2 to 3 months ago would be my guess. Whenever like sellers were kind of feeling like maybe the market was shifting a little bit, and they're having these conversations with the realtors, and the realtors like, hey, if you're thinking about selling, now is probably the best time to do that. Well, by the time they think about it, get their stuff ready, get the house ready for the market, get the house on the market, here's where we are, And so I think that those people were just trying to hit the highest part of the market. And unfortunately, with inexperienced agents that tell them that they look at a comp, a CMA, and they're using those CMA numbers from the months that they were listing, like 3 months ago, then they're throwing their homes on the market for what is a price that obviously the market's not bearing right now. So naturally, you put it on the market for a higher price, you're going to have it to take price reductions. And I really just think that that's what's happening right now, especially the stuff I've been looking at with clients. Like there's a lot of houses, yes, but like a lot of them aren't good. They're just not good. They did no work to prep them. They don't look good in pictures. They don't look good in real life. There's no work that was done to them. And people are still listing them for what I consider to be top of market pricing.
Yeah. I mean, I don't disagree with you. It's funny as everything you just said. I made a video a while ago saying that sellers would sell too late. I wish they would have seen that and called me earlier, because I could have got their homes in the market. Secondly, we've been saying that once this amount of inventory hits, things are going to change. So there's another video that we made. I feel like all the videos that we've made kind of are accumulating to what we're seeing right now. So let's shift gears here a little bit. Sarah, with the amount of 0.75 rate hike today, I want to hear your thoughts on this, how it's going to impact the actual interest rates that people are having, because there's a lot of people saying interest rates are going to continue to go up. I'm one of them. I've said interest rates are going to go up, but we also have had people on this channel who said interest rates are not going up. They're going to go down in October. So with this 0.75% interest bump, or not interest, but percentage bump, what do you think is going to happen, and what's on your radar?
Yeah, sure. So I think, oh yeah, it is on. Good. No, what I was going to say is that the 0.75 Fed rate hike today was received well. It was kind of leaked before that they were thinking about 0.75 or 100 and or 75 bips or 100 bips, which is 0.75 or 1. And they did land on 0.75. That was leaked, and that was received well. There was no surprises. Honestly, usually what happens isn't the announcement of the rate hike itself, but it's the conference it's that Jerome Powell has with everyone post the announcement. And everyone is usually hyper focused on everything he says and they nitpick it to death to see if there's any clues in there on where the Fed's head is at and what they're thinking about doing in the future. So that's usually what actually ends up being more impactful than the announcement of the Fed hike itself, because everyone knows that's happening. Now, with that being said, there were no surprises in the press conference today. And usually you can expect some sort of knee-jerk reaction both ways when there's the day of a Fed rate hike, but that wasn't really the case today. We've been holding strong. Rates actually started seeing an improvement since the European Bank announced that they were doing a rate hike themselves for the first time in 11 years last Thursday. We actually saw a boost there because it was well received by the bond market, because it's showing a global combating of inflation. And so the 0.7 rate hike is a good thing in regards to mortgage rates. It doesn't mean your mortgage rate is going to go up by 0.75%. What it means is that the Fed is combating inflation like we were hoping they would do. And it's actually going to cause rates to get better. And as they continue to do the Fed rate hikes to combat the inflation issue, we should see interest rates start improving. And kind of what I talked about at the beginning of the year, the last couple of times I was on here, is I was saying at the end of the year, we should start seeing some improvement in rate. And so we're starting to slowly see a little bit of that now. And I think once the QDP, once the GDP report comes out, the second quarter in September, and it shows that we are in fact like about to hit a recession, I think that's when we're really going to start seeing more improvement at the end of the year.
I want to stay on this, but I do want to talk about not in the future, but bring up the fact about the White House trying to change the definition of what a recession is. That's something that we need to talk about on here. So don't let me forget about that. But so you've seen the bond market. So people understand how the bond market works and how interest rates work. Explain that a little bit as far as interest rates for homes don't necessarily correlate to what the Fed does. So why don't you explain that real quick?
Yeah. So the Fed rate is like the daily rate of something. So so when the Fed increases their rate, it's going to directly impact short-term financing and short-term loans, like daily interest on things. But when you look at a mortgage, it's long-term. It's we're looking at a 30-year loan. You're looking at 30 years, 25 years, 20 years. So when we look at the bond market's looking at the Fed rate and the economy and being like, okay, where are we going to be this year down the road, like 30 years down the road, 20 years down the road, because they're holding a note when they're selling bonds. They're going to be, sold and holding that for a longer period of time. So the Fed rate immediately affects short-term interest accruing items, but not in credit, and it doesn't directly impacts long-term interest and credit differently, because that's more of the long-term outlook of where our economy is going to be. So if we have a positive outlook and it's more solid economy, then it's going to be a positive influence on the bond market. So Fed raising rates right now to decrease inflation, so we have a better, more stable economy, is a positive for the bond rate, which is positive for mortgage rates, meaning that mortgage rates will improve because there's going to be the outlook of a more positive economy down the road. I hope that's a little clear. It's a little technical.
No, it's good, because I think, the average consumer doesn't understand or doesn't really realize where or how the rates are derived for these. And so they hear Fed's going to raise rates. That means that interest rates are going to go up. And so in their mind, that's what that means. Or if the Fed lowers the rate, that rates are going to go to zero. You're going to get a free home. That's not the case either. So it's good to break that down. Guys, what questions do you have for Sarah when it comes to all this?
My first thought is, do you agree with Mr. Squatting Bear's comment that just popped up, that it would take until early Q1 of 2023 for the rates to see an improvement? Or do you think it would be sooner than that?
I think that we most likely will see something either end of this year, beginning of next year. I think that's in line. I don't think that that's super optimistic. I think that is in line with what we've been seeing. And now, especially with what the announcement that happened last week with the European Bank and what we're seeing right now, we have seen a steady improvement since the June rate hike. So since the June 15th rate hike, we have seen a steady improvement in, and when I say improvement, no, I'm talking about like tiny numbers here, because I'm talking about like 1/8 of a point, like 1/2 a point, things like that. So, but we've seen an improvement and we've seen it stay steady. And so we've seen kind of like a little stair step. And so with this rate hike, we're going to see that continue to stair step, most likely. That's the projection, because everything's following what I've been saying, is that we're combating inflation. That's all they want to see. And then once we have that under control, then rates are going to start coming back down. I don't think they're going to come back down in the 2s or the low 3s, but they're going to start coming back down.
So your most recent lock that you can think of that had no anomalies, no variables, just a standard W-2 employee with a 740 credit score, what were they looking at?
So we did with a 30-year fixed, it was I think it was like 5.25, around there. It was in the 5s. And then for ARMs, which would generally end in a high, and when you have high inflation And with the market like this, sometimes ARMs make more sense because they're looked at a little bit differently because they're based either on like LIBOR or something like that. So it's a different type of market. Like those right now are, if you don't buy points, that most of those are in the 4s right now. So it just depends.
How many of your buyers are buying points?
Ooh, that was my next question.
It's a good question. So right now, if someone is going under contract today, honestly, like I don't recommend buying points in this market right now. I don't think that that's a good move. Just because most likely because everything is pointing at a recession. Like we have inverted yield curve. We have, we have high inflation. We have already projected numbers for second 2 quarters in a row of negative GDP. Like the only thing left is job report. And honestly, the job report numbers are skewed because how they calculate it is they net it out. So we actually have higher unemployment, but more people have gotten out of the job market where it's netted out, where that unemployment number stayed the same. So that's the other shoe to drop. Once the unemployment number comes out and that goes higher, then that's like, yeah, those are all the indicators of a recession. So
what would a recession mean for interest rates?
It means interest rates will come down.
Mm.
And
everybody should pray for a recession.
Historically, yeah. So historically, well, yeah, if that's what your goal is, if your goal is lower mortgage rates, yes, globally, when a recession happens, mortgage rates go down. And that historically, that's happened every single time we've had a recession. And so once that happens, like we're already prepped for it. We already know whatever, most likely any clients that lock in a rate right now, they're probably going to be refinancing in the next year or two. So I'd much rather them save that money and not spend a ton in points. I had someone come across yesterday, they're spending 2.5% in points, or 2.5 points, I'm sorry, for a rate. And I'm like, well, that might sometimes, it depends on everyone's scenario. It may make sense for you. I don't know. Everyone is different. So I can't do a blanket statement like that. But most of the time, it doesn't make sense with the market right now today to buy points because most likely you are going to refinance into that lower rate and you might as well use that money for other things. It just doesn't, it doesn't really make sense.
Let me ask you this then. So we've had this recently where we've had a couple clients go under contract and we negotiated in closing costs because, hey, we can do that now. Mm-hmm. So you're saying it's not a good idea to use that to buy down the rate?
It depends on everyone's scenario. Like maybe that person has a situation where they need to have more cash, don't want to spend as much cash out of pocket because they need to have that in the bank because they feel more comfortable, or they just don't have a lot of money in the bank. And so they don't want, they'd rather have that money go towards closing costs. So they're having less money come out of their pocket to pay for that house. But if they're okay with that and it's just extra money and it's icing on the cake, and that's where you just have money kind of like to spend. Sure. If it's free money to you and you want to do it, go for it. Like if it's not going to be used on anything else. Otherwise, I would say probably save that money in closing costs and then use it to refinance in the next year or so.
But again, it would make more sense to just apply it toward the principal.
And that's another thing. You can apply it for additional down payment, or you can wait until you close and then do lump either recasting, depending on how much money it is, or like a lump principal payment. And you could, depending if you recast, you can lower your monthly payment that way. And then you can also get some years paid off. You can get your house paid off, a little bit earlier actually, because that actually influences your payoff time of your home. If you pay off that principal more quickly and do those additional principal payments. So I would say there's definitely ways that you can strategize to have that money work more towards for you. I think it's just, as a consumer, and if you're not in this, you are automatically programmed on interest rate. And that's all you're known for. It's like almost prideful, right? It's like, oh, I got this really low interest rate. But you want to make sure that you're strategizing with whoever you're working with to make sure that you're actually putting that money to good use to you and for you, like in regards to equity, payoff, what your plan is, etc.
I don't know if I ever asked this. From closing, is there an amount of time before you can recast? I know we talked about it for refinance, but for recasting?
Yeah. So for recasting, it depends. Who you recast through the company you got your loan through, and each person is going to have some different guidelines depending on who your loan is held by and who it's being serviced by. Typically, Depending if it's Fannie Mae or Freddie Mac, you could have a 1 payment to 4 payment wait period before you could recast. It just depends on the loan servicer that you're using and if they have any overlays or specific guidelines for recasting for you. And then also whatever those current guidelines are for Fannie and Freddie, because any guidelines are always subject to change. But it's really, it's usually like around $150 to do. And then you usually need at least $10,000 for recasting to put towards your principal.
Interesting. Yeah, we just did that on our mortgage on our house. We just purchased, we closed, and then we took money out from our other closing and used that to recast. So we were at a 4.2%. So let's see. There's a couple questions in here. Do you think anything happens with rates before the midterms?
I mean, honestly, what we saw, I think this is a little bit of a difficult question in the sense that what we've seen in the recent past versus historical past has been drastically different. With the last couple midterms, the rates were actually really sensitive to the news and to like politics and everything else. And historically, that wasn't as much the case as it has been in recent history. So it's really, kind of up in the air what we'll see there. I think it depends on what comes out and how it gets spun with the White House and the recession and everything else too, personally. Unless that wasn't what was asked and I just took that in a different direction.
No, that's good. Next question on here. California says it's expat mortgages are actually cheaper than conventional mortgages. Matt, yeah, I don't know if I got your email, but I definitely saw the Samsung news. I did a video on my Instagram about it. So what does low interest rate and recession mean for Austin housing market? Well, we're not in a recession. Well, this should bring us to our question about what a recession is, but I want to get there in a second. Let's do this. What are the changes? What are the chances lending requirements on conventional and refi loans tighten with the recession?
Honestly, I don't think they are, just because so much changed during what happened in 2020 and 2021. And I think you got as tight as you possibly could get in 2020 with everything that happened in our industry. And things have kind of lessened since then. And everything is really conservative. I think sometimes when we talk about recession, people automatically go towards the most recent one, which was 2008. And this would not be anything close to 2008. It's just not the same. It's just not, it's not going to be like that when we talk recession. It's going to be more like the historical recessions we saw in like the 70s and in the 80s, 90s, 2000s. It's not going to be what we saw in 2008. And so I don't see there's going to be any guideline changes besides what's standard as of right now and everything that we've been saying.
I'd say one thing that's interesting is that with people pulling back from buying, BlackRock's pretty happy because Aaron's point right here, right now, rents in my area are more expensive than my mortgage. I still see supply issues. Thoughts? I mean, what are your guys' thoughts on that? I'll let you speak, Kevin. You're muted, dog.
I think his face is frozen.
Sorry about that. I mean, obviously, I've been really concerned about the rents anyway. I don't know if you saw this graphic yesterday that says Austin's rents are up by like 108% or something like that. Did you see that graphic?
No, I'll put up. Go ahead and keep talking.
But anyways, it's hard for me not. I just saw that BlackRock did another fundraise for another however many $1 billion to buy more houses, like 50 billion is how much it was. And some of it's coming from, 401ks and teacher funds and stuff like that. On a side note, I think it's ironic that the working class that funds 401ks puts their money into, like, they're buying houses. They put their money into a 401k. That 401k is sent to BlackRock, who buys houses under them and drives the prices up for their own houses. You know what I mean?
And then loses 1.7 trillion.
Yeah,
the stock
and then
market.
but I mean, the point of that all is saying like, we've seen this coming down the pipeline for a long time about the rental rates, them driving rental rates up, and this is actually great for them because it drives rental rates up. It scares people away from the purchasing market, which theoretically now will drive down prices a little bit, which will allow them to snatch up some more houses at prices that aren't quite so, unfavorable for them. And they're not going to stop doing it. They're still raising money. So it just solidifies to me, even like when companies like when funds like them are raising 40-50 billion dollars a year to buy homes, like that's a bolstering. They purchased 30% of all the homes in Texas last year. So do you not think
Well, I
that
mean,
they're
we
going
don't know that they bought 30%. It was like 28% was, and I read that article and I tried to, their definition of an institutional buyer was very liberal in what it was. So basically, if you bought it in an LLC, they considered that as a institutional buyer.
Mm-hmm.
So,
well,
but BlackRock,
yeah.
I'm not going to lie, BlackRock bought a lot of properties here.
Yeah, between them and other people. But the other thing, this is just me speculating too, just anecdotally, that I also believe that a lot of people that purchased, because last year and the year before, purchasing a secondary property as an Airbnb was really popular as well. And I see now that that's getting a lot of backlash. Just generally owning Airbnb properties, people are saying it's not worth it anymore. They'd rather just stay in a hotel. I can see now a lot of those people who are short-term renting them, moving those investments more into the long-term rental category as well, which I think is actually good. I would love to see more inventory in that rental category to help soften those prices a bit, because they're ridiculous at the moment, like absolutely ridiculous in Austin.
So our rental property in New Braunfels just got a contract on it, and it took a little bit longer on there, but man, I had so many issues with like the Zillow freaking rental thing. Like it wouldn't show up. It's such a pain in the ass, but I mean, those rates that we got for that were pretty strong. So, but that, I mean, I'm a mom and pop investor, but yeah, I mean, so this is what the interesting part of this is, that if you can't buy right now, or you're thinking, okay, I'm not going to buy because the market's going to crash and rates are going to come, rates have got to come down or they're too high. I mean, this stat, Kevin, you nailed it. 108% increase in rentals in Austin. 3,200 is the average. Isn't that freaking insane? I
think it is, because if you look at even a year ago, those numbers were, I look at, though we've had this conversation a year ago when we were really hype on talking to people about buying investment properties as well. And a lot of people were concerned, like at the time when property values increased in Austin, the investors that I was working with were like, well, I can't just, like, at these prices, the rent's not even barely covering my mortgage. And I'm like, but it's always lagging. It's a 1 to 2 year lagging indicator, or not indicator, but it's a 1 to 2 year lagging number, the rental rate. Once the home prices get up and then those people can't compete and they're forced into the rental market. This is exactly what's happening right now. We talked about it a year ago. This is exactly what's happening. So the investors that purchased properties a year ago are really thriving at this moment. You're at the end of your first year lease. You're writing new leases. I told you about this last month when we had these people, 130 inquiries on a single family home in Tech Ridge. So, I mean, this is not uncommon. We knew this was going to happen. It's just I feel like it's too much. The jump is too much.
It's too much. Reversing subject back here, Sarah. How do traditional home lenders compete against home builder lenders if home builder lenders are offering incentives that can go against the principal?
So I think that you're asking like if they are giving you, a money incentive, because technically they can't contribute to the principal of a home. That legally the borrower is the one that has to come up with the down payment, unless they're using a down payment assistance program, which can go towards the down payment, but no one else can pay their down payment for them. Or unless they're getting a gift which has to be from a family member, or like a love or a significant other or something like that. So, if they're giving like an incentive for closing costs, that is limited as well. There's certain, depending on what type of loan you're getting, they can only get so much money. And that's kind of tricky too, because sometimes on those contracts, they're like they're like, we're going to give closing cost incentives up to $15,000, $12,000, $8,000, whatever that is. And so you have to make sure that you can actually get that amount of money, because sometimes you can't. It depends on the loan type. So that, and how much closing costs you actually have on the deal and things like that. So that's something to be aware of. But I would say that it's gone both ways. I have a lot of clients that are under contract with new construction, and we've ended up being the better option. I have some where the builder's the better option, and I let them know that. So it really just depends on what that incentive is. And if it's something that we can match or better. A lot of times there are, I had this last week where there was a big deal builder, and they made it sound like they were doing this really amazing thing, giving over $10,000, la da 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 da. And then we looked at it, and their fees were a lot higher. So the difference was way smaller. I think it only was like $1,000 or $500 at the end of the day. And so it was like, okay, like we can make that work. That's easy. So, I mean, it really just depends. And that's why it's important not to just go off what they say and really get a second opinion, and go to that trusted lender or resource you have to make sure you have an apples to apples comparison and you're really getting what makes most sense for you and your family.
So we just closed one this week where you represented the buyer in a Perry home.
Mm-hmm.
So it definitely can be done. So the next question on here that we have, and I think this is a really good one for everybody, Samsung trying to bring another $200 billion in investments, coupled with Tesla here in Austin. Sounds like Austin is going to become a hub for AI. What are your thoughts on Samsung's announcement that they were looking for incentives in Williamson County, I believe? I'll pull up the article as you guys start talking, but that they're trying to bring us like 192 million. I edited a video on my Instagram about this, but ended up being an additional 10,000 jobs. What do you think, Ian?
Where are they gonna?
So, and this is going to go more to my point. I have a screen that I was going to share. I don't know how relevant this is. This gets more into macro versus microeconomics. I think looking at if people can live anywhere, I've mentioned this 100 times. If people can live anywhere, where would it be? If you think about AI jobs specifically, do they have to be in office? Right? I don't know the answer to that. And that changes what happens when people are looking to purchase. So, I was in Colombia last week, and I had so many people that they're engineers or software related. And they said, cost of living is so much lower that I can live there and have investment properties in Austin and elsewhere and increase my income substantially. So there are a lot of people that are thinking that way if they don't have families. If they do have families, it's a different story. So I'm always just paying attention to how many people have to be here versus want to be here. Because that's going to be
I think that's a
direct attribution to the industry that you're looking at. So if you're talking AI, how many of those are young, single people that have no families and are ready to go anywhere else? Like they're nomads or nomadic. How many of them? I would venture to guess a large majority. Or if their country of origin isn't even here, and they may consider going elsewhere.
Interesting. I was on, Christina Smallhorn was here yesterday or Sunday. She did her live stream from my house. And we were talking about like the investors that were still buying here. And we're talking the fact that more Chinese buyers are starting to come back and out of the country buyers, foreign buyers are starting to buy again, partly to do with the fact that the restrictions are lightening so they can come back out here. And I was telling her that it's interesting, like I have a lot of clients that are, buying a home and then investing in more home. And a lot of them are people here on like H1B1 visas from like India. Like we have a huge population buying. So they're not necessarily, they're here, but they're really kind of still it's a weird loop that they're still kind of not necessarily a full citizen here. So they're kind of still a foreign investor. What are your thoughts on like all foreign investors popping back in?
Are they popping back in?
I don't know.
Well, I look at it,
or is it just BlackRock popping back in?
Yeah. I mean, I saw an article that said foreign investors are not jumping back into the U.S. housing market yet. Not yet.
Okay.
I have investor clients, but most of them are like here. I did have a lot of foreign investors that were looking to buy, last year and the year before. I've had one or two come back, but I have had more people coming back to start looking at buying investments again, but not necessarily foreign investors per se.
Gotcha.
Yeah, I mean, if it's a cash transaction and they can hedge against the inflation, I think that it could be a wise move. The interest rates don't affect them the same, yet they can still get a lot of their costs reduced by having the seller pay for it. So it's a good time for them to be able to negotiate as an investor.
Gotcha. All right. Well, I want to get your thoughts on this. So from the White House, let's pivot from the White House. So typically when you think of recession, they say a recession is 2 consecutive quarters with falling real GDP constitutes in a recession. Now they're trying to change that definition because they're saying, so instead both official determinations of recession economic assessment of economic activity are based on a holistic look at the data, including the labor market, consumer and business spending, industrial production, and incomes. Based on the data, it is unlikely that a decline in GDP in the first quarter of this year, even if followed by another GDP decline in the second quarter, indicates a recession. What are your thoughts on this, especially being I don't want to get political, but is this more of a move because it's an election year, or I don't know. What are your thoughts on this, Kevin?
Sometimes I don't know if I should even share my thoughts on this kind of stuff because
you should. That's why we bring you on here. So
no, I mean, I get it, but say what you want to say about whether you agree with one person, one side or the other. I don't care if you're conservative or liberal, Republican, Democrat. I don't care. If any other White House was saying stuff like this, there would be massive backlash. Okay, we're just going to change the definition or alter the definition a little bit based on what we think we want to have happen at the moment. I see a lot of this lately, really downplaying things that have been for decades. Very clearly one thing, and then saying, okay, well, no, it's not really the same. We never really said that GDP is 2 quarters. I actually have been looking this up too. A lot of information online right now is not saying 2 quarters of negative GDP. It's just saying a period of high interest rates and low economic growth over an extended period of time. This is why I don't like, I think often you should be saving things off of the internet that are relevant, because those records can get corrected and you'll never be able to find proof anywhere of any of this information. It's funny, this is completely irrelevant to that, but I saw these videos about there's apparently verses in the Bible that have been left out recently in printings of the Bible. They're just not there. An entire verse number, it'll go from 16 to 18. Verse 17 is completely gone because the new printer decided for some reason it wasn't relevant anymore. And I'm like, that's really, really odd to me. But I know in the internet, they've been doing this for a long time. Actually, the Democratic Party years ago, back in 2015, started, and again, I'm not dogging on one thing or the other. This is just a fact. They created a group called CTR, which is correct the record. It's the only purpose of CTR is to go scrub the internet and change things that they think are inaccurate, meaning they don't agree with it. It's not an accurate thing. So they're just going to remove it from the internet to correct the record. That's their full-time job. So same thing for this, at some point we'll all say, wait a second, I thought Chick-fil-A was spelled CHIC, not CHICK. Like, and then you go back and can't find any proof of it. Or I thought, Sinbad played this role of Shazam, and it actually wasn't a thing that was even, real. So I don't know. That's just my thoughts on that.
That was Shaq, man.
Or Shaq or whatever.
That is so nuts, though. With that, it's like 1984 is like banging in my head. Thanks, Kevin. Well,
it's true.
No. Well, I was just gonna say that reminded me, and this is totally not. This is like the other side of things. How apparently they go back and shows on Netflix and stuff, and they will actually edit them and change them entirely. So if you go back, they can be completely different because they decided they didn't like something in it. And I was like, oh, that's weird. And then it's changed forever. But anyway, that's on a lighter side, I guess. But
revisionist. How do you think? But so I guess my question then, really for you, Sarah, is if they're changing the definition of what a recession is, and let's say these numbers come out that we're actually in a recession, but we're not because not by this administration's definition, how does that impact the bond market? How does that impact interest rates? How does that impact housing? Do we actually see interest rates go down? I think that's more of my question. And then, Ian, I want to get your feedback too.
Sure. Yeah. I mean, I'm at the end of the day, numbers are numbers, right? Like we can't, unless they're physically changing the numbers of what's like forging numbers or falsifying data, like numbers are numbers and they are what they are. Like you can call it whatever you want. You don't have to admit it's happening, but that doesn't mean it's not happening. So like with the GDP, like Yellen is coming out and trying to like prep. I don't know, like I'm going to be really positive about this. And maybe they're just trying to like not make everyone go into panic with recession because everyone just has 2008 because that was the most recent one that happened. I don't know, but I'm being very positive with this. But basically, it's crazy. It is crazy how they're coming out and saying like, oh no, this isn't going to lead to a recession. If the negative numbers come out, they're just negative numbers and it's okay. And it doesn't mean recession. And I just think that that's not being very honest. Some things I read said it's just to mitigate, fear and panic. I don't, and that could be the case. But historically, we have never had, every time that we've had 2 quarters of negative GDP, there has been a recession, period. In the whole history that we've ever measured this, you can look it up. If we have 2 quarters of negative GDP, we are in a recession or gone into a recession. Like and we can only go off of the historical data, right? We can only go off of previous experience. So the numbers, the data, they are what they are. And if you don't have to admit it, but it's still happening. That's my opinion. And that's what bond market looks at. They look at the actual data.
Yeah. What are your thoughts, Ian?
To quote this guy who's pretty controversial on the internet, he says, this is not saying, you're for or against them or anything like that, but he says, facts don't care about your feelings. You know who that guy is, yeah? Everybody knows who that guy is?
I'm aware.
And I look at it like it'd be really cool if we just had a site that published data, no words. Like how interesting would that be? It's like, hey, this is happening. Hey, this is happening, but no words, because the words, which is what we're seeing on the White House website, are more fluid. They're designed to attach to your emotions and make you make decisions on that, or create a smoke screen on that. But I think overall, the data, like you said, it's historical data. Every time this happens, we end up going into a recession. And I think 2008 specifically was an anomaly with how it transpired. But every other one has still been that way. And you can't change that. I think just being prepared for it is also being prepared for it. And then looking at, who our current population of buyers and sellers and money movers are. That could be a factor. But the numbers still don't lie.
Can I share my real thoughts on it after having this thought for the last 2 weeks and watching our markets move? Let me tell you really.
Yeah.
Who's responsible for the shitty state of our economy are the market makers. 100%. The reality is the market makers are the ones that are driving the shitty activity. They're shorting companies. They're using the volatility in our market to create opportunities for themselves to gain wealth. And they are responsible for putting us in the situation that we're in right now. There's no way around it. You know, if you really want to look at it, if you were to let companies trade as they will, if you're let the consumer, like we as consumers, I believe are not fearful and negative. We're cautious, but we're still investing in the things that we want to invest in. We're still buying cryptocurrency. We're still buying cars. We're still working. We're still buying homes. We, as the public, the general public, are actually really doing what we're supposed to do as good consumers, good citizens, supporting the economy, going to work, doing all these things. The market makers are the ones that say like, let's short the shit out of Tesla right now and drive down the entire market. Those are the people that are creating this fear. And you can't tell me that that's not done on purpose to create this volatility for them to make more money.
And that's
well, I mean, let's be honest. How many stocks did you short last year?
Me? I don't short stocks.
Okay.
I don't
You
short
have call
stocks.
options, right?
I
don't know the difference between call options.
Well, I don't short stocks because I don't bet on our economy failing. I don't. I invest in opportunities I think that are good, and I don't bet on someone failing. And what happens is these guys get behind, they get behind these type of situations, and they try to drive the market down to create opportunity for themselves to invest again. It's just the same type of stuff with what's going on in our housing market right now as well, creating opportunity for them to buy more houses.
I love the most recent comment that came in. It says, "Wow, what is this, a rant session?" But their name is Question Everything. Come on.
I mean, like if you really want to know how I feel, we can go outside here and I can talk to you guys. Anybody, you can go Discord, call me one-on-one, and I'll tell you exactly how I feel about this stuff. And I promise you,
I talk to you all the time about it. I love getting your
population even knows.
And maybe I'm wrong, or maybe I'm actually volunteering a perspective that you haven't thought about before. I'm just saying, don't trust everything that you've been told.
And Kevin has diamond hands, not paper hands. The Gordon Gecko. So let me ask you this though, Sarah. So let's say, okay, regardless of the definition changing, we see two declining, quarters. And let's say it's inevitable that we're currently in a recession, or about to go in a recession. What do you think that actually means for the housing market, for interest rates, and all the above? Because earlier you said that going into recession would actually bring down rates. So my question is, does that drive people back into the market? And does that help with all these price fluctuations we're seeing right now?
Yeah, I mean, typically in that type of market, you do see, people going back and buying more, ironically. So you usually end up seeing a stronger housing market come out of it, because by having the interest rates go down, it does open up the market, and having, sales prices a little bit more in line with where I think we all feel like they should be. It helps more people get back into the market and buy. And then again, that helps stabilizes by increasing that business. It helps, stabilize the economy because it's increasing more business from people buying homes to get, us at a more stable level. So it's this, it's a roller coaster. That's how our economy goes. You have ups and you have your downs. And when you're up, you do think inflation is up, the market will do things to, lower to lower, I can't, I'm like, sorry, I'm having like a brain fart. But basically what they do is when inflation's high, they do everything they can to slow everything down in the marketplace. And so they can combat the inflation. And then when they go the other way and we have a recession, they try to do things to help build it up and increase the market the market and help stabilize it. So it's constantly fighting to kind of get things here. And you go like this while you're trying to do that.
Yeah. So we're seeing a lot of, and I did a video about this a week ago, a lot of FOMO sellers, right? So they're doing what buyers did a while ago, where they're seeing the market start to soften. So I got to sell before prices come down, because there's people out there saying the market's going to crash 50% or whatever. What are your thoughts on if, let's say, in 4 months they announce that, hey, we are in a recession? Do you think people selling right now just have paper hands? Ian.
I remember when I was actually trying to buy a house in 2008, and I didn't close because it was right as the recession was starting, and they said, the appraiser came back and said it's not worth it, yada yada. Anyway, didn't close on it. And so, but I remember learning a lot more at that point. And the thing that sticks out is be ready for when there is, and if you have the cash, you'll win. If you're ready for that to happen. I'm not saying that you want it to happen, but I'm saying this is where a lot of people historically that make good decisions with their money gain wealth, because there's opportunities out there. You know that prices are down, jobs are lost. You may be in a position to be able to improve your livelihood and that of your family and friends. And so I would just pay close attention. I don't even know if that was part of the question, but that's how I feel about this situation. I think people are more educated now than they were, because 2008 kind of came out of nowhere for people, where now we've been talking about it, and there's YouTube and there's all these things across the internet that are educating or partially educating people, but at least they are aware that something is happening.
If you hear everybody saying the market's going to crash and everybody assuming the market's going to crash, people just assume it's going to crash and they start waiting for the crash. I'm a little disappointed by Patrick Bet-David coming out and doing what he says. It's funny. I get a kick out of Patrick Bet-David going after realtors all the time. Oh, the realtors this, the realtors that. The guy sells insurance. Insurance people, I got a good friend, Paul from Allstate. Let's be honest, like, insurance salesmen are no better than a realtor, no better than a mortgage lender, no better. So he's over here trying to say, oh, I'm so great. But come on, man, like you defraud people. Okay, I can't say he defrauds people, but like there are times that like insurance does not pay out when it's supposed to. So don't say that you have the moral high ground here, buddy. Anyway, sorry, that's my little rant. Sorry, no. Somebody said something about a rant.
Let me add. I'm going to add one thing, and I'm going to move on from this.
Okay.
Two things. One, 18% of all market trades happen in dark pools, mean off exchange, that you can't even participate in. So about 20%, 1 out of every 5 trades happens in a place that you have no idea even happens before you even have the opportunity to do it. Those are the people driving the way that a stock moves. Like when earnings come out, they're the ones that say, okay, cool, earnings came out, that didn't hit our targets, we're going to move it this direction before you even have a chance to, and before a market even opens. Secondly to that, 60 to 75% of the remaining volume is actually traded on algorithm. So 20% is traded off market, 18% is traded off market, 60 to 75% is traded on market, but with algorithm. Which means for me, if I'm going to, and this is probably not sound logic, but let's just say that those are one and the same. That means that you and I trading daily on stocks account for maybe less than 20% of all the volume that's even being traded. So you tell me who's responsible for moving the stock those directions. It's not us, it's somebody else. Anyways, I'm going to put that off to the side again and say this. I'm done with that. But I think what's probably going to happen is that I don't think that we've seen the bottom yet of where the housing prices are going to come back to, because at this point, what happens is once you, like with any asset that you can see is coming down, you're going to see it peak, and most people aren't going to get in for a while until they can see it level back off again. So I think it's going to be a while before a lot of buyers jump back into the market. But then when they do, I think they're going to all jump back in together with retail, like investors, like people that are buying investment properties again. So, but I don't think that's happened yet. I think that we're still at least a few months away from that.
Yeah. Well, and I wanted to hit something too on something you guys said about the prices coming down. And I will say this as well, is that we haven't seen any depreciation yet. We're still appreciating. And a lot of people, when they talk about crash, they don't realize that a housing crash would actually mean that we have depreciation of homes. And I think it's something around the 30% decrease. And I know the numbers just came out, and I actually, wanted to make note of it for today. And Case-Shiller just came out with their report, reciting that there's still in May, because it's always behind, is a 1.5 increase in appreciation in May. And then in FHFA came out saying that they had a 1.4% increase in appreciation in May. So we still are seeing appreciation in home prices, and it's still estimated it's still going to be in the 1%. And the standard is about 4 historically. We just saw crazy appreciation the last 2 years, like 19%, 20%, which is unheard of. So yeah, we'll see a decrease compared to if you not in your actual appreciation of value, but in the case of, last year it was 20%, this year it's only 1, somewhere in the single digits, 5%, 6%, 1%, whatever that is. But your home itself is still appreciating. It's not depreciation in value.
Right. And that's the biggest thing is in no other year have I seen over, and especially Austin, over really 12% increase year over year. And we saw 30, 40, 48% year over year increases. Those increases were not sustainable. And so the fact that we're going down, I think, what are we at now? 13% increase year over year, somewhere around there. I think by the end of the year, we're probably going to be barely, less than 10% increase, but that's more realistic to what we see in a normal market. So the question is really, how does that translate into 2023? Do we start seeing negative numbers because we saw such a peak so early this year, or do interest rates drop because we're in a recession and then people jump back in the market and start buying, preventing us from really seeing a deep crash? So those are all things that I think, we're going to have to look at going forward. None of us have the magic ball that tells exactly what's going to happen. Even the channels out there that say the market's going to crash hedge their bets on that it's going to take 5 years to crash. So Ian, what are your last thoughts?
I want to talk to the most recent comment from California. He said he bets that North Austin will not see a crash because the entry point was lower. I don't think it's because the entry point was lower. I think it's because of the types of jobs that are here right now, and the amount of infrastructure that it currently exists and is still being added, and they haven't decided to pause any of that yet. I think that's the only reason why North Austin is mostly going to stay pretty stable.
Yeah. I like this question by Joe. So best area for investing as the Austin area, quote unquote, corrects. Burbs, downtown, north, south, what area do you think is the biggest crash? That's a good question. I would say if you look at it, central Austin or Austin proper saw a $53,000 price decrease, where the MSA only saw 13,000. So, maybe you're able to get something really good on the east side. But what are your thoughts on if you're buying? Amazon sells crystal balls for $34.99.
It's funny. It's true.
Mm-hmm. Kevin, if you were to invest, what area would you think is you'd get the best deals?
Best deals, or me, I'm Mr. as close to downtown Austin as is humanly possible. So what I've been noticing, because I'm trying to find something as well, there's still in Austin for unique properties, there's so few still that the prices are, maybe they're coming down a little bit, but there's still not very many options. And the things that are actually really good quality are still selling with multiple offers. But in the suburbs, there's a lot more options now that are available. So I think you're going to see the most drastic decrease in suburbs because there's so many options available.
Yeah.
Got my finger on a buy button too, waiting for the right thing to come up and it's just it's not happening. Even though there's more inventory, it's still not quite what I'm looking for.
You cannot buy a 1-bedroom condo downtown for less than $600,000 still.
I was going to say it's mostly due to the price point. I mean, anything with any substantial amount of land it's going to kill you.
You know, I've been looking at condos downtown are like pushing, some condo buildings are pushing $2,000 a square foot.
It's nuts how some of those condos are really expensive. I think that it's a little different in the Austin area because I think everyone's mentioned before, it's because of the jobs that are here, the companies that are here, and everyone has moved here and is continuing to move here. And we also have like upper execs and things like that. And it's not like when we see a decrease in, the housing market, we still have a healthy housing market here, I feel like, versus other parts of the country. So we might not see it necessarily in Austin as much as other cities in other states might see it that don't have a lot of businesses moving in and a lot of other, people moving in and supporting the local economy.
It's crazy. I have some friends that grew up here and they're ready to buy. They've been ready to buy. And then, the pandemonium hit. And now they just had to leave just because of pricing. They were priced out of their own neighborhood, and now they are moving to North Carolina. So, and I know a few of those situations where people are just like, I can't do it in Austin, but they've been here the whole time.
I've heard that too.
Quickly.
Yeah, because I've been here. I'm pretty much an Austinite. I've been here since I was like 30, right? And a lot of people, I've seen the same thing. And people I grew up with, and they're like, we miss old Austin. They have the old Austin fan club, and they'll quiz people like, do you know who Leslie is? Like, and all this stuff. And if you do, you meet the requirements for the club. Yeah. They're just like, we love it here. This is our home, but they got priced out of everything. Like, unless they're staying with family, which, they really don't want to do because of their age. They just don't have any place to go. And it's really disheartening. Except if you go out to maybe like other like rural Texas. I had someone go under contract in like Chico, Texas for like $149,000. So that might be a price point for some folks, but it's not near anything. So.
Yeah. I just pulled up on the MLS under 250,000. There's only 212 homes out of, what are we at, 9,500 homes. And in Austin is probably only like 60, or around the Austin area, 60. The rest of them are like people in Houston put their, and San Antonio and New Braunfels all put their stuff in our MLS, which is crazy. So, I mean, I'll show you in a second here, but if you want free ice cream this weekend, here's a shameless plug. I have a listing on Mandevilla in Grey Rock Ridge. We're going to do Mr. Softy. You got to come in, give feedback on the house for the little thing, and then we're giving you coupons to go have a Mr. Softy little treat there. So come by South Austin, 5201 and 5205 Mandevilla Drive. We're going to do that this weekend. I think that's it for us, guys. We're at an hour. My back's killing me on this new chair. So we're going to go. Thanks, everybody. Make sure you like, comment, subscribe, and we'll catch you